All right, guys, this is probably my most requested episode so far. This is the big share episode. So I guess overall, when I think about like the basics of share investing, I come back to one principle. Investing is like sex. Everyone wants to do it. Everyone says they're an expert at it in one way or another. Everyone has their own secret moves and hot tips, but most of us just aren't very good at it. If you like my videos, make sure you hit the subscribe button because it allows me to do more of them, spend more time doing this, less time doing my job. Prefer to do this. I'm going to use terms specific to the Australian marketplace, but these all apply globally. I'm just using an Australian trading platform. The fundamentals are the same wherever you trade in the world. Let's kick it off with the ultra fundamentals. What's a share? A share is a portion of ownership within a company. So if you buy a share, you're essentially becoming the part owner of a company. Before you start thinking, well, I'm the part owner of Apple, I'm a big dog now, I'm gonna go in there and jack myself an iPhone. You need to realize that you own a very small portion of it. So as an example, there are 18,823,263,000 shares on issue of Apple. If you buy 5, you're not telling Tim Cook what to do. What it means is you're a part owner of the business, which means you're entitled to a portion of the profits of the business, which is kind of what this share thing's all about. Everyone's making bank on the stock exchange at the moment. How do I make bank on the stock exchange? I'm not going to tell you how to do that because I legally can't and I don't want to get sued. But I can explain the fundamentals of shares and then you make a decision on what you want to do about investing in them or not investing in them. Don't sue me. To get a few fundamental questions out of the way. You can buy shares in any exchange in any country. So as an example, I'm Australian, I can buy shares in the US stock market. Just be mindful that if you buy shares in other countries, you own a portion of a business in another country and will affect your taxes. To be honest, I'm super lazy and I only own Australian shares because I can't be bothered dealing with any of that. But if you want to get into that, knock yourself out. The key thing to think about before we go buying shares is what are your goals? How long do you want to hold the shares for? Do you want the shares to go up in value? Do you want to get income from the shares? What do you want? If you only want to have income sitting in somewhere for like 6 months, buying shares might not be for you because the longer the investment time frame you have, the more likely the returns are to do what's called reverting to the mean, which means if it goes up 10% one year and down 10% in the other year, that nets out to 0. So the more time that you spend in the market, the more regular the return will be. That also means that if you decide you want to be in the share market for a month and it's a bad month, you might lose a ton of money. What I'm saying is make sure if you're going to get into shares, you want to have a longer time horizon, maybe like at least a couple of years. The second thing to think about is your risk profile. The general rule of thumb is that if you're younger and you have longer and you don't need the cash right now, you should invest in riskier assets. So as an example, if I was in my 60s or 70s, I wouldn't buy shares in a brand new tech startup because it might go broke, it might take 10 years before it makes money, I don't know what's going to happen. I might buy shares in like a super stable company like Apple or Google or Coles or Woolworths in Australia, super stable companies that just spin off cash. The next thing we need to learn about is what's called diversification. So the way to think about diversification, don't put all your eggs in one basket. If I had, say, $100,000 to put into the share market, just because it's a round number, I would probably put it in 6 or 8 different shares. Because then if by some weird cataclysm or financial fraud, one goes completely under, the rest are still there. It can be risky to put it all into one. And right now, we're not gambling here, we're not speculating, we're thinking about longer term investing. The first step when you're looking to buy shares is you need to have a trading platform. So you need a way to physically go and click buy to buy the shares, right? In Australia, I use SelfWealth. A lot of people use E-Trade in the US or Robinhood. You jump on there, you sign up, they give you a number, off you go. You just have to send some money into the share trading bank account. Let's say we send 500 bucks in. We're good to go. We're off to the races, let's buy some shares. The first thing we need to do is think about analyzing the share we want to get. So my first thing I do is I try to learn about the company itself before I go buying shares. I'm not just going to pick a random code and just shoot from the hip. Apple is an example. The first thing I'll do is I'll have a look around at Apple. I already know all about Apple because it's Apple, but I'll still go through the exercise. What do? They make phones, they make computers, they make software. I know that they're a really large company. I also then have a look at their numbers. I go, oh, okay, their revenue last year was $200 billion, $270 billion. Their EBITDA was $77 billion. EBITDA is earnings before interest, tax, depreciation, and amortization. That's basically their more or less operating profit. Are they paying a dividend? Ooh, they're paying an 80 cents per share dividend. So that means for every share I have, I get 80 cents, which puts a dividend yield, according to this, of 6.64%. Apple's not giving me a very good dividend, but they're going up a lot. They're also a really stable company. Again, what I look for when I'm looking at a share is the revenue, the EBITDA, if they pay a dividend. I'm looking at the yield, and I'm looking at what's called earnings per share, or EPS, which is basically their profit divided by how many shares they are to get earnings per share. The other thing I like to look for is what's called the PE ratio. Now the PE ratio is important. It's the price to earnings ratio. So what it means is how many times this company has to generate this profit in order to pay for itself. In abstract, the number's not that important, but the ratio tells you how high the expectation is of growth. So Apple's PE ratio is 39 at the moment, which is about the middle of the range, which means I have to hold this share for 39 years at the current rate to make the price back. If I look at a company that's a rapidly growing company that might have a PE ratio of like 100, it means that the market expects it to grow so much and earn so much more money that that ratio will come down. So there's no hard or fast rule with a PE. It's just like a factor to look at. I'm gonna look at another company and just have a look. Let's go. Telstra, which is one of the largest companies in Australia. So their PE ratio is 20, which means the ratio is lower, so they pay a higher dividend because they're a much slower, stable company. So this is the sort of company you'd get. They made a $23 billion turnover. They made they made a $1.8 billion profit. They paid a dividend of 8 cents a share, which is a yield of 3.24%. It's not bad for doing nothing. They're pretty stable, sort of thing I'd look for. All these things you look for together, and feel free to rewind this video and do your own little analysis on a company when you find it. I want to look at the earnings per share, the yield, the dividend, the revenue, the EBITDA, the market cap, just to see how big they are. That's like the total amount of shares and the total volume, to give you an idea of what's going on. So if I look at a company, for instance, that hasn't made a profit, I'll use Afterpay, because they're a really good example of an Australian company that's blown up. They made a turnover of $519 million. They had an EBITDA of $44 million, but their net profit is negative $13 million. So they didn't make a profit this year. But their price is $133 a share for some reason. And they don't even have a PE ratio because they haven't earned anything yet. So people are so sure that this company is going to make so much money. That's why this company is going nuts, even though it has no profits. So there's another thing which is relevant to certain companies, especially in Australia, called franking credit, which you may have heard about at elections. Boomers love them. A franking credit is essentially when the company that you invest in pays tax already, right? So it pays its company tax. And then it gives you that credit to use in your own taxes. So if I've got shares in, say, ANZ Bank, which is a big bank, right? And they've already paid tax on their dividend, and then I get the income from the dividend. Why should I pay tax on it twice? So I get a tax credit. When you're looking at shares, it can sometimes be useful to see if they have a franked dividend, it's called franked dividend, or not. Because maybe then you're getting tax-free income, which is the best income. So if you do lots of research and practice a lot, you can get a little bit better at it, much like sex. Not much better, according to my girlfriend.